what do Foschini, Shoprite and Massmart all have in common? They, together with other listed retail shares, underperformed the JSE All Share Index. But with the drop in interest rates, could this change, and which one should you be putting into your shopping bag? To find out, I'm joined by Edgar Mafoko, who is a portfolio manager at FNB Wealth and Investments, and Nick Crail, senior fund manager at Ashburton Investments. Gentlemen, welcome to the show. Nick, I'd like to begin with you because I see that currently Foschini is the gem in the sector. Its share price was up by about 9% in the first half of the year. What is making this counter so attractive?
Well, I think, as you sort of alluded to a little bit earlier, retailers themselves have come under a lot of pressure. And really, if you have a look at Foschini over the last, let's say, 5 years, they were at a stage a company that was underperforming with a business model that was not necessarily optimized for sort of scale. And I think really what you've seen is significant managed turnaround focus and the right sort of conditions for a company with many different brands within its portfolio to do as well as it has.
And quite a lot of brands they do have in their portfolio. But Edgar, your view on Foschini and whether you'd also be putting it in your shopping bag like many investors currently?
I think definitely. I think one that's outperformed, and I think rightfully so. I think they've gotten quite a lot correct, I would say. I think Nick just mentioned the offering, that they have. They have, kept up to date with the trends. I mean, if you look at if you just walk into a retail center, I mean, there's literally everything for everyone. And I think if you look at the stocks that have underperformed rather over the last year or so, the fashion mix, for example, has been one of the negatives for them. But I think Foschini definitely at these levels. I think one that's I think fairly valued at these levels, I would say. But I think definitely for the future, I think definitely one to put in your shopping bag, I would say.
Talking about underperformance, Truworths seems to be leading the batch there with its share price down 22% in the first half. Nick, is this all down to a bad fashion mix from the side of Truworths, or are there bigger concerns here?
I think there are bigger concerns. The management execution, as well as I think the longer term strategy, are both lacking. When you have a look at Truworths, specifically relevant or relative to the other competitors that are out there at the moment. I cannot see the time when they have turned things around. Is it too early? I would say it's too early to get involved. Meaning almost like Massmart, these are companies I would sort of firmly be sticking away from, even though they have underperformed, and arguably there might be some value there, more of a value trap.
I mean, with Truworths, when it comes to management, there's always a conversation around whether it's time for the current head of the company to go, to bring in perhaps younger, fresher blood to help with its execution. But your take on Truworths and why it is just not finding favor?
I think it goes beyond just the CEO. I think you need a right mix within the team itself. I think whether we see a shake-up over the next few months or so will actually be very, very important. But I think in terms of news flow, I think over the last few weeks, we saw negative news flow coming out of office for them. So that's definitely a negative. And I think it will challenge management, and how they handle the entire situation, I think ultimately will define where the share price goes over the next few months or so. But I think in terms of getting your fashion mix right, I think definitely you need to bring in all the right people. And I think the upcoming update from the company will really go a long way with regards to whether it soothes investors' views of the stock, or whether the stock actually does continue to derate as we've seen it over the last few weeks.
So like Nick, is this one that you're staying away from? Or
I would stay away from Truworths for the time being.
All right, staying away from Truworths. Staying with the clothing retailers just for a moment. Woolworths down 15% in the first half, but they recently coming out with a trading update showing that things are turning the corner. I'm just interested with Woolworths right now after having suffered quite a distraction to its share price as a result of a whole range of concerns. Should you be getting in now at these current levels, given that things look like they're improving?
I think so. I think so on a couple of different metrics one's got to have a look at. Woolworths, obviously not just a fashion retailer.
Sure.
Large portion of that business, and really the gem in that business has been the food business. I think that will continue being a gem and continue doing well. If you have a look at fashion, they really have underperformed quite significantly over the last, I would say, 5 years plus, made lots of mistakes. This was the first sort of time where they've announced to the market that they looks as though some of their sort of strategic strategic rethinking is starting to pay sort of yields and dividends when it comes to the SA clothing side. If you have a look at the current valuation, I think, of Woolworths, it largely discounts any sort of valuation attached to David Jones. Your big risk there is that they try and allocate too much capital to David Jones, which continues to make losses. If they don't allocate the capital there and just have spent what they have spent, I think you'll see them write down that further, possibly into these sort of results. But really the core of the business then is whether you can turn around fashion, which they're looking as though they're doing, and then the gem, which is food. So in my view, yes, certainly a company I'm interested in.
I mean, Ian Moore saying that the strategy of going back to basics seems to be working for them, and it's true. So now you know that if you just want a simple a blazer, a simple shirt or so, you go to Woolworths. It makes it easier to choose as a consumer. But your take on Woolworths?
Correct. I would say once you strip out David Jones and Country Road, definitely looking, I think, very attractive. But I think as Nick just mentioned as well, I think it looks like we're getting a bit of momentum with the local South African sales part of the business, which is a positive. I would have loved to have gotten in a month earlier because I think it's up about 10% for the month to date. So quite a nice performance from them. But I think it all depends on what really happens in Australia going forward. If they do turn that around, I think there is still quite a lot of value in Woolies. But I think at these levels, I would say still offers fair value. But I think if I had to choose between some of the names that you've mentioned, I think Woolies definitely up there with Foschini in my view.
I was quite surprised to see the performance of Mr. Price in the first half of the year so far, because it seems, according to their latest trading updates, that sales momentum is looking good. They're getting their fashion choices right, not making mistakes of the past. But what is it why is Mr. Price underperforming so significantly so far?
Well, I think if you have a look over the last couple of years, that'll have been one of the best performers. Arguably, they just became a bit too expensive.
Right.
I think if we look into the trading update, so what we were expecting up until the end of last year, the share price had run away a little bit, thinking that a little bit of momentum seen in the sort of, let's say, third and fourth quarter or the third quarter of last year would continue through to the fourth quarter. Didn't happen. So that's really what led to this high base that I think you've seen in Mr. Price. It has subsequently repriced itself quite significantly. I'm still not sure if there's it's massively discounted relative to the current economic environment we found ourselves in. However, I do think that this is it's trading at its fair value, maybe slightly beneath its sort of fair value at the moment. Looking at retail, I think in SA, as you alluded to right in the beginning, what we need for that sector to do well is a turnaround in the South African consumer.
Sure.
So a 25 basis point interest rate cut, is that really going to provide enough of an impetus and boost for the sector to do well? I'm not necessarily convinced. We could be a little bit early in terms of having a look at the sector itself. However, this is a quality company that I think through the economic cycles will continue to do well. So certainly when you see a little bit of value that's there, you're playing it for the long term, a great one to have.
Sure. I mean, many people do agree with you that the 25 basis point drop in interest rates not really enough to move the needle. So things are expected to remain quite tough. So if you are looking to, wanting to look nice, Mr. Price could be your choice as a consumer. And I'm just wondering, as an investor, do you expect this to happen, and therefore would you be bagging this stock in your portfolio?
I think from a valuation perspective, yes, it has pulled back, but it is a stock that's always traded at a premium to the sector, and I think rightfully so. They have delivered, but I think the last update that we got from the company wasn't the greatest, and I think rightfully so. The stock has pulled back, but there's been pressures. I think you've seen the likes of your Pick and Pay clothing, for example, come into the sector, and I think a lot of competition. But I think the biggest threat, I think, for Mr. Price in the short term is inventories, because they are sitting on quite a lot of stock. Whether we're going to see markdowns coming through, which could lead to further margin deterioration, will be a big factor. But I think ultimately, I think the pullback is an opportunity, I would say, in my opinion. It is a quality company, and I think from what you've seen in the last few years, whenever they do get it wrong, the company is able to actually come back and turn things around. If you look at Woolies, we're only really seeing the turnaround now, but I think Mr. Price has always been very quick to actually turn things around when things do go sour. So I think in the long term, definitely, I would say Mr. Price offers value at these levels. It has pulled back significantly from its long-term averages. So I think definitely a buy in my opinion.
All right, at a good price, it seems.
Yeah.
But just bringing in all those macroeconomic headwinds that are facing the sector right now, the economy is not growing as quickly as would like to. There's high unemployment. We read about people losing their jobs every other day. Households are highly indebted. Quite a lot of push factors. My question is, and to bring in the food retailers in on this as well, which stocks or which companies are likely able to better weather this current storm, and which ones would sort of not be so lucky? Edgar?
So I would definitely favor something like a Shoprite, for example. Definitely my pick in the sector. But I think the one factor that's been at play over the last few years is that food inflation, actually for the major part of 2018, was actually in deflationary territory. And I think for this year, that will play a major factor. I think you should start seeing food inflation really come into play here. And I think that should be good for the likes of Shoprite. But I think moving away from that, they had a bit of a watershed year where you had a lot of factors really weighing on the stock. So not just operational issues. I mean, there's issues around the tight-end shareholding, for example.
Sure.
I think you've seen the share price pull back on the back of that. So I think
down
definitely
19%, I think.
Yeah. So I think definitely an opportunity for shareholders. And I think as Nick mentioned as well, I think these are long-term buys. So even though there is value in the short term, but I think in the long term, they do definitely offer even more value in my opinion.
All right, most people, fund managers, always have Shoprite in their portfolio, but is this one that you're keeping as well? And also, if you can just add on to that, the SPAR Group.
Yeah, so Shoprite, without a doubt. I mean, at the end of the day, what you would like in a long-term portfolio is quality. If you have a quality company with significant sort of market share, a significant balance sheet sort of strength and optimization on that sort of side, you can weather so much bad news that actually comes through and go through these sort of economic cycles. If you have a look at something like a Shoprite, it has derated significantly, in which case this is the perfect time to get in. Right. Often you find with these quality sort of stocks that they trade at this lofty premium, and then when there is economic bad news or other bad news, it then derates. When it derates is your opportunity to get in. So also very happy, very similar to Edgar with regards to that. SPAR, you know what, it hasn't performed that badly this year on a relative sort of basis. It is still down, make no mistake. I have concerns around the business model, and that is just into the longer term. So obviously having taken a significant amount of their ammo offshore more recently and looking to build that side of the business, it must be said, they have generally executed that very well. So hats off to them. But certainly as you get scale in different markets, things become a little bit more complicated, nuanced and the rest. And I think your risk goes up actually quite significantly. In that environment, I think it's not one that I would really have a look at. It's not to say that I think it's the worst of the bunch. It's certainly not, but it wouldn't be up there with my top picks.
All right. So concerns around its business model. Ireland looks to be, doing pretty well for the SPAR Group. I think there's still a bit of concerns around what's happening in Switzerland. But your take on SPAR and whether you are as pessimistic on SPAR as Nick?
So I would say I think over the last year it has done well. It hasn't underperformed to the tune of a Shoprite, for example. But I think from a business model perspective, as Nick mentioned, I think they've executed, well enough. But I think there will be questions, going forward. I think Ireland, a very good market for them. They've actually also increased exposure to Poland, for example, which has done well. So I feel like all the good news is probably in the price at the moment. So I think definitely something I would look to avoid for now. But I think, nevertheless, a very quality operation. But I still go back to Shoprite and say, look, at these levels, I would say more value there for me. All
right, just quick final thoughts on Pick n Pay. Would you buy?
Quite frankly, no, I would not buy. I think as Edgar alluded to a little bit earlier, Shoprite have had quite a lot of operational and other issues all hitting them at the same sort of time. If you have a look in the South African market specifically, Shoprite and Pick n Pay really are the two sort of more dominant type of players that compete with each other. You went for multi-years where Shoprite outperformed Pick n Pay. You've now recently had a couple of years with Pick n Pay, I think, outperforming Shoprite. Now is the time where you would sort of rotate out of that and decide to go with Shoprite. So Pick n Pick n Pay on a
And
relative
not for Pick n
basis,
Yeah.
not even close.
And just quickly, Edgar, we are out of time because Pick n Pay have got this partnership with Time Bank now, and I understand Time already has some 400,000 or so customers. I'm just wondering, if I'm walking into a Pick n Pay knowing I'm going to get an account of some sort, and then why not do shopping as well? Could the Time partnership not be a boon for this company?
I think it could work, but then again, you don't want a situation where you get to a Pick n Pay and it's overcrowded. So I think good for both companies, but I would just say, just based on valuation, just something I would avoid for the time being.
Okay.
But I think, yeah, good partnership from both companies, but not convincing me to change it to a buy rating. Yeah.
All right, gentlemen, thanks so much for your time. Of course, I was in conversation with Nick Crail, who's a senior fund manager at Ashburton Investments, Edgar Mafoko, portfolio manager at FNB Wealth and Investments.